Hey everybody, Economic Ninja. I want to talk today about something that I truly regret that I did not take part in during the Great Recession of 2008. An opportunity that I missed, and I guarantee you I will not miss it this time. But I want to share it with you because I want you to be a part of it too. And it's something that people don't pay attention to these days. And I'm going to start with talking about how the stock market is a total illusion. It's totally fake. See, the stock market, you only make money is if you buy low or sell high, or if you get into shorting stocks where you borrow higher and sell lower. You're literally only making money one way from stocks, really. Um, all people do is they speculate. They speculate that they buy a company, a stock share in a company, and they believe that that company is going to make more profit someday, and that means the company's stock is going to be worth more. And literally, you get nothing other than speculating. It's absolutely insane. But that's not how it always was. And there still is another way of making money from stocks, and that is through dividends. And something that happened in 2008 that I watched happen, and I didn't have the guts to get in. And I'm so upset that I didn't. But yet I have a buddy that is a very wealthy, let's say, very, very wealthy. And he did it. He did this in 2008. And and we had a conversation about it. And what he did is he bought dividend stocks. And dividend stocks are very rare. They're, you know, think about it. Companies used to have to pay a dividend to convince you to buy their stock. And so these days you don't. After the 1987 fiasco and then the recession of 94, and then you started seeing like this bubble being built up in the dot-com stocks. Since then, dividend stocks really took a back seat to all these wild speculative plays from not only dot coms, but the tech sector. And so companies figured out, man, we don't have to pay these people to buy our stock, to hold our stock. That was the key thing about a dividend, was not only to attract an investor, but get them to hold the stock, because every quarter you would pay out, based on how many shares, a dividend on your money. And so let me give you an example of what I witnessed in 2000, because I've been a stock investor since 1998, maybe 97. But I had a couple of dividend plays and I got paid, but I sold them, right? I was essentially still speculating on the price of the stock. And I didn't think of the big picture. So let me tell you, let's give an example. Old companies like Exxon, and I don't remember if Exxon gives a dividend. I haven't even looked. But these older companies, these massive multi-billion dollar companies that give out dividends, right? They tend to be older companies, right? Established companies that know the way they used to attract people. And so let's say Exxon was running at $10 a share and it gave a 1% dividend. Oh, crap. This is fast math. Let's say 1% dividend, which would be 10 cents. So it's a $10 stock and it was giving out a 10-cent dividend, which equated to 1%, right? A 1% dividend. And let's say it was giving it out every quarter, or I'm sorry, total over the year. Over the year, it equated to a 1% dividend. 10 cents. 10 cents. Now it's a $10 stock. Now that's before the crash of 2008. This is what happened. When the Great Recession started and all stocks started selling off in late 2006, and they started to trend down, and they really accelerated their downward trend into 2008. What happens is, let's give an example. And these aren't real numbers. I'm just making these numbers up off the top of my head, but to give you some reference. You owned Exxon stock and it was at $10 and it paid uh, a 1% dividend, 10 cents a share over the course of the 4 quarters in the year, right? So it's split up by 2.5 cents every quarter. Well, now Exxon sells off. Well, it's not because, it's not necessarily something Exxon did, but Exxon price starts selling off. It starts going from 10 to 9 to 8 to 7. And it's selling off for a myriad of reasons. One being speculation that because there's a recession now, people are going to be driving less, so they're going to be using less fuel, and so Exxon's going to sell less, right? Um, but then they also sell off because hedge funds and big investors and retail investors are having to sell their best performing stocks because they're losing their tail on these highly speculative stocks. So they're getting margin called and having to make up. And so they're selling their Exxon stock. So it's just exacerbating that drop, right? So now let's say Exxon goes from $10 to $5. Now this actually happened in between 2008 and 2012. It was insane. And I didn't do it. I'm an idiot. Exxon kept paying their dividend. Never changed. And I'm just using Exxon as an example. I mean, Exxon may not even be I want to say it was Exxon that I was looking at mainly, but they never stopped paying their dividend, and they just kept paying their dividend. And so instead of a you know a 1% dividend, let's say it was 10 cents right per year, they're still paying 10 cents a year, but the stock is now at $5. There were even so now think about it. Your dividend on a percentage basis has gone up exponentially. Now that's some fast ninja math, but I'm pretty sure 10 cents, that's fast ninja math. Tell me down in the comment section what that percentage is now. I could do this math. Let's say Nexon went down from $10 and it was paying a 1% dividend of 10 cents to now it went down to $1. Well, now that 1% dividend per year, return on your money, you're getting it cash in your hand. You got to pay tax on it, but you're getting it in your hand every year, getting a check. Now you buy some more Exxon stock. You're like, shoot, Exxon, I had it at $10. It's now down 90%. I'm going to level up. I'm going to go literally buy a ton more Exxon shares at $1 because I believe in the company. I believe it's going to stick around, right? Now you're not making a 1% dividend because you're still getting 10 cents. Since it's now $1 the share, you're now getting a 10% dividend. Well, now check this out. In 2008 to 2012, I watched companies that were paying a 1 to 2, maybe 3% dividend go to a 14 to 18% dividend. Now, isn't that insane? I didn't buy any. Now, think about this. If I would have bought those shares at rock bottom prices back then, they'd be worth 10 times what they are now, right? But on top of that, and this is the story about my buddy that did this, he still has those dividend paying stocks. He bought them when they were pulling, like he would put $100,000 into these stocks back in 2010. He's now pulling 12 to 18% on his money, right? So he's getting $12,000 to $18,000 a year on his based on his $100,000 portfolio. His portfolio now is worth millions of dollars, but he's still pulling that much money. But what's even greater, that dividend, he's still pulling that 12 to 18,000 bucks. But he says, but actually what happened is over the years, as the company got more successful, it kept going up in value. To retain ownership, the shareholders, they would raise the dividend. He's like, I'm making even more. He goes, why? That's literally a form of cash flow, where a lot of people run to cash flow in the real estate sector, which I do. You got to also think there's some types of stocks that can actually perform, make cash flow. And yes, he goes, the valuation of the stock, the companies go up and down over time. But I bought it for the cash flow. After a certain amount of years, I got all my money back. It was, I think he said like 4 years, 4.5 years. He got all of his $100,000 back. Now, everything's gravy. Not only the stock value, his portfolio is all paid for. He got his $100,000 back and he put it into something else, but also those dividend checks, all gravy. And I want you to be thinking about that during this next crisis as things go down. Start looking at dividend stocks. You'll actually see some stocks that weren't dividend paying stocks become dividend paying stocks because they know that they need to retain ownership, those shareholders. They need strong hands, those diamond hands you hear about all the time on YouTube or on Twitter. They need that. So they actually become dividend paying stocks because they need to be able to keep not only they don't want excess liquidity. They want people holding on their stock, and that actually brings value to their stock so that they can borrow against their company's value at better rates, so they don't over dilute their company. So I just want to give you that thought because a lot of people don't think about how to make money. They just think about when the stock market crashes, so I'm going to buy up shares of Amazon super cheap. But you're probably really missing out by going for like the Amazons and the Teslas when you're missing out on like the big ones, the Exxons, the big companies that pay dividends. So I just wanted to give you that thought. Hope you guys got something out of this. The Economic Ninja is out.